Welcome to the Deep Dive. We're digging into the Q3 2025 earnings call for Colgate Palmolive. CL is the ticker.
Yep.
Our goal today, simple. We want to pull out the key signals from what management said, cut through the noise. We really need to understand why the stock did that weird dance, dropped hard, then kind of bounced around confused before closing the day up strong. What changed? What did the market finally buy into?
Well, that confusion, it really highlights this tension, right, between their big strategy shift and just the tough environment they're in. Colgate's not just reporting numbers. They're trying to pull off this major transition towards their 2030 goals.
And doing it when things are messy.
Exactly. Consumers are uncertain, costs are high, geopolitics. It's a lot. So the big question is, were the weak spots just the market conditions, or is something else going on with the strategy itself?
Okay, let's start with the headline numbers, because they really did send mixed signals. First, the good news, they beat on the bottom line.
Right. GAAP EPS was 91 cents. That's up 1% from last year. And it beat estimates by 2, maybe 3 cents.
And the base business EPS, their non-GAAP figure.
That was flat year over year, also 91 cents. So it shows they've got a decent handle on costs, on earnings control. Good defense, you could say.
Revenue looked okay too, $5.131 billion, up about 2%, mostly in line with what the street expected. So far, so good, right?
It sounds okay on the surface, but you got to look at how they got that revenue. That's what spooked the market initially.
The organic sales?
Precisely. Organic sales growth was, well, sluggish is putting it mildly, just plus 0.4%, barely positive.
Okay, 0.4%. How did they get there?
Entirely through price. Pricing added 2.3%.
So they charged people more, and that was the only reason organic sales went up at all.
You got it. And the flip side of that coin,
yeah,
volumes. They dropped significantly, down 1.9%.
Ouch. Price up, volume down. Classic sign of
rising elasticity. Yeah. Consumers are pushing back on higher prices. They're buying less, maybe trading down. That explains the initial caution, definitely.
And margins felt the heat, too.
Oh, yeah. Gross margin pressure was noticeable, down somewhere between 170 and 190 basis points compared to last year. That reflects, higher input costs, but also more promotions to try and fight that volume decline, plus some specific operational hiccups we need to talk about.
Okay, so bottom line sentiment initially. EPS control looks solid, but that organic growth is weak, and the volume trend is worrying.
That's the picture.
All right, let's unpack this volume drag. Management clearly pushed back, saying it's temporary, right? They kept pointing to their big strategic plan, the 2030 plan.
That's their main story. They kept hammering home, we're executing the plan. It's their justification, their path forward.
So what are the core pieces of this 2030 transition they're pinning their hopes on?
It really boils down to 3 main pillars. First, innovation. They want a faster, more science-driven pipeline for new products. Premium stuff, value stuff across the board. Just get better products out faster.
Makes sense. Second
is a huge push into digital, data, and especially AI. Agentic AI specifically. This is where they get really future-focused.
Agentic AI. Okay, that term's everywhere now. For listeners maybe not deep in the weeds on this, what does that mean for a company like Colgate? How does agentic AI help sell toothpaste?
Great question. Think about revenue growth management, or RGM. That's all about getting the most profit from every tube of toothpaste or bottle of soap you sell. Traditionally, you look at past sales data, maybe run some models.
Right.
Agentic AI aims to make that process active, not reactive. The AI isn't just analyzing the past. It's supposed to be doing things, suggesting local pricing tweets in real time, optimizing promotions on the fly, figuring out shelf placement based on competitor moves right now. It's moving from analysis to automated decision-making.
Okay, so it's about getting smarter and faster with pricing and promos using AI. That does sound like a potential weapon against that elasticity problem.
That's the bet. Long-term, they think this can really help them manage pricing and demand more effectively.
Got it. And the third pillar?
The third is omni-channel. Basically, getting volume back up across all channels, online, offline, while defending their big market shares. They still have over 41% in toothpaste globally, over 32% in manual brushes. Huge shares to protect.
And how are they paying for all this new tech and focus?
That's the Strategic Growth and Productivity Program, or SGPP. Fancy name for restructuring and efficiency efforts. It's designed to generate savings to fund these big investments in AI and innovation. We'll see charges related to that starting this quarter, Q4, and running through 2028.
Spend money to make money, or maybe save money long term.
That's the idea. Invest now for future efficiency and growth.
Okay, strategy sounds ambitious, but let's circle back to the immediate pain point. The guidance cut. That had to be a major reason for the initial stock drop.
Oh, absolutely. Cutting guidance is rarely taken well. They lowered the full year 2025 outlook for organic sales growth pretty sharply, down to 1-2%.
From what previously?
They were guiding 2-4% before.
A cut.
So yeah, a significant cut. And they were upfront about why. Consumers in developed markets are getting more price sensitive. That elasticity, again, and competition promotions are heating up.
But here's the crucial part, the twist, right? They cut the top line, but kept the bottom line guidance.
Exactly. That's the key. They reaffirmed their outlook for both GAAP EPS and adjusted EPS. That contradiction, lower sales, same profit target, is what the market eventually seemed to latch onto.
How do they justify that? How can sales fall short but profits stay on track?
Management's message was basically, look, the market's tougher than we thought, so sales will be lower. But we've built enough wiggle room in our operations through cost cuts from SGPP and smarter RGM that we could absorb that hit and still deliver the earnings we promised.
So confidence in their cost control and maybe that RGM stuff starting to work?
That's what they're signaling. They're also aiming to keep non-GAAP gross margin roughly where it's been year to date, around 60.1%. It's a bold claim, essentially protecting the bottom line at the expense of maybe some short-term top-line focus.
Let me push back a bit here, though. Is just cutting costs and managing the P&L enough if volumes keep falling? Isn't that just managing decline eventually? When does the market demand real volume growth again? Are we sure this 2030 plan isn't just a nice story to cover up deeper problems?
That's the million-dollar question, isn't it? And it's the critical question investors should be asking. I think the market gave them a pass this time because the reasons they gave for the volume drop felt specific and temporary.
The golden excuses, as some might call them.
Yes, perhaps. If they convince investors that the big volume hits weren't systemic rot, but these one-off fixable issues, then the strategy funded by those cost cuts suddenly looks much more credible. It buys them time.
Okay, let's get specific then. If the strategy is sound, what were these acute issues that hammered the volume number, that negative 1.9% overall? Where did it come from?
Right. It wasn't death by 1,000 cuts. It was really two big punches. The first, and probably most concerning from an operational view, was Latin America, LATAM.
What happened there?
It dragged down volume for the whole region by about 150 basis points. That alone hit company-wide gross margin by maybe 40-50 basis points. It was tied to a very specific problem, an issue with the flavor or formula of their Colgate, Total Clean Mint toothpaste.
An issue? Like
reports of temporary mouth irritation.
Oh, okay, that's not good. That's more than just pricing pressure. That's a product quality issue. Do they have to recall it?
They termed it a voluntary replacement of trade inventories. Started in Brazil, then they did it proactively elsewhere. They sounded confident they'd fixed it and then the shares would bounce back fast after the relaunch. But yeah, a major own goal, a self-inflicted wound that explains a big chunk of that volume miss.
Okay, one major hit. LATAM quality control fumble. What was the other big?
India.
Yeah.
Organics, they were down mid-single digits. But this was totally different. It's about government policy.
Taxes.
Yeah. India changed the GST tax rate on oral care products. Dropped it from 18% all the way down to 5%.
That sounds good for consumers. Lower prices.
Long-term, yes. Management thinks it's positive for consumption eventually. But short-term, chaos for inventory. Retailers knew prices were about to drop because of the lower tax.
So they stopped ordering the higher tax stuff right before the change hit.
Exactly. Why stock up on inventory that's about to become cheaper? So it created this artificial air pocket in Colgate's sales to the trade for the quarter. Reported volume plummeted, even if underlying consumer demand might have been okay.
Okay, that makes sense. A temporary disruption due to a policy change. Very different from the LATAM issue.
Totally different drivers. So you've got the LATAM quality issue, the India tax inventory issue, and then there's Hill's Pet Nutrition.
Right, Hill's. Always a key part of their story. How did that do?
Overall, the pet category, especially dog dry food, is a bit soft right now. But Hill's did well in niches like cat wet food and their prescription diet line. The key thing for volume, though, was a deliberate drag. Yeah, they're exiting the private label pet food business they were doing. That strategic decision created about a 300 basis point headwind to Hill's volume this quarter. It's planned pain.
And that continues.
It'll still be a drag in Q4, but management said it should be pretty much done by 2026. So another factor that makes the volume look worse short-term than the underlying core business might be.
Okay, so putting it all together, the big volume hits were an operational mistake in Autam, a government policy hiccup in India, and a planned business exit in Hills. It's actually harder to argue that's a sign the whole core business is collapsing.
And that's exactly why the stock recovered, I think. The market looked at those specific, explainable reasons and decided they weren't signs of a fundamental breakdown, even in North America and Europe.
How were things there?
More promotions in the U.S., definitely seen that elasticity. They mentioned weakness specifically in the U.S. drugstore channel.
Yeah.
But they called the promo environment still rational. Europe actually looked pretty good, still getting price, especially with premium stuff like their Elmix brand. Science-based innovation is working there.
So tying it all back for the investor, the market initially freaked out about the volume and the guidance cut.
Right.
But then they listened to the explanations for the volume drop, the Golder excuses, and decided they were plausible temporary issues.
Plausible and, crucially, fixable. And that allowed the focus to shift back to the reaffirmed EPS guidance and the big 2030 strategy story.
The message became, okay, near term is bumpy because of these specific things, but we're protecting profits and we're investing heavily in AI and innovation to win long term.
Precisely. The market effectively gave them permission to prioritize the strategic overhaul, funded by cost savings, over chasing potentially unprofitable volume in a tough market right now. It became a bet on their execution of that 2030 plan.
Makes total sense. If those volume issues really are temporary, then the underlying business isn't broken, and it's getting this potentially powerful AI upgrade. So, looking ahead, what are the key proof points? What do we need to see to know this bet is paying off?
Yeah, good question. We've got kind of a three-point catalyst map. First, pretty obviously, we need to see organic growth pick up sequentially as that LATAM mess cycles through and India normalizes. Basic blocking and tackling.
Step 1, stop the bleeding.
Right. Step 2, we need confirmation that volume is actually starting to rebuild because of the strategy, not just because the one-offs ended. Look closely at their guidance for the first half of 2026 when that comes out.
And the third, the big one.
Tangible proof that the agentic AI stuff is actually working. Is it helping them fight elasticity? Is it driving better RGM outcomes? Is it creating demand? We need evidence, not just talk, that the AI investment is paying off.
Okay, that sets the stage perfectly for our next segment. Time for the wild, maybe brilliant, maybe crazy trade idea based on all this. This is not financial advice.
All right, let's get speculative. The core idea here, we're calling it agentic alphabet.
Agentic alpha, I like it.
Look at Colgate's stock performance over the last year. It's lagged its peers. It's lagged the consumer staples sector, the XLP. It's even lagged its own historical returns. The market is clearly pricing in this current slowdown and the execution risk of the 2030 plan.
So the market's cautious. Where's the opportunity?
The opportunity lies in the speed of that AI adoption. Management is pushing hard on agentic AI for RGM, for personalized marketing, for supply chain efficiency. What if they pull it off faster than the market currently believes?
Faster than the consensus models assume.
Exactly. What if that agentic alpha, the real benefit from the AI, kicks in 6, maybe 12 months sooner than people expect? If that happens, Colgate could surprise everyone with a volume recovery much faster than that cautious 2026 timeline implies.
So the bet is basically that their tech implementation outpaces market skepticism.
That's the core of it, the trade itself. This isn't a short-term flip. We're thinking long-term options, maybe something like long January 2027 calls.
Way out there.
Yeah, it's a bet on the full cycle. A bet that they successfully navigate past the LATAM cleanup, past the Hills private label exit, and that the 2030 strategy, powered by that faster-than-expected AI impact, really starts driving volume and allows the stock to break out of its recent underperformance. It's a pure bet that the market is mispricing the execution speed and capability here.
A bold bet on AI-driven execution, turning the ship faster than expected. Okay, let's wrap this up. Key takeaways from the quarter.
Strong EPS beat, that was the good news. Held the line on profit.
But paired with a significant volume disappointment, driven largely by those specific acute issues, the LATAM quality problem, the India tax disruption.
Right. And the market, after digesting it, seemed to accept those explanations and focus instead on the big strategic story. The 2030 plan is go, funded by SGPP, heavy on AI, with a clear commitment to protect that bottom line EPS number.
Which leaves you, the listener, with our final thought to chew on. Is this current weakness we're seeing in Colgate just a temporary blip, a cyclical headwind in a tough market, maybe offering a decent entry point for a company that's seriously leaning into AI for the long haul?
Or is that guidance cut a warning sign, a signal that maybe the volume challenges run deeper, are more systemic than management is letting on, and the AI story is just that, a story. Something to consider.
Definitely something to mull over.
And please remember, what we've discussed here is analysis and information. It is absolutely not investment advice. Always do your own research and consult with a qualified financial professional before making any investment decisions.
Great stuff. Thanks for diving deep with us today. We'll catch you on the next one.